Welcome to the Get Real Podcast, your high-octane boost of full-on reality therapy for personal, business, and investing success with your host, Ron Phillips, because somebody's got to tell it like it is.
Hey, everybody. Welcome back to the Get Real Podcast. Ron Phillips here. Have you ever wondered how cash flow and the rest of the returns, which are appreciation, depreciation, and tax incentives, how they all interact with each other? On a previous show, I had talked about cash flow running the business and the real wealth is built from the other returns. And I got a question. So if you weren't wondering, I know at least one person was, but my guess is that there are probably several of you out there who are a little bit confused. So to help clear up the confusion, I am joined by Brendan Seiber, who is our director of sales internally here. Loves running numbers, enjoys spreadsheets, and loves real estate. Welcome to the show, Brendan.
Yeah, appreciate you having me on again.
Brendan and I love running numbers, and we're constantly running numbers together and looking at numbers. And I thought, man, in addition to that, Brendan is consistently talking to and explaining these kind of things to investors all the time. So I thought, man, let's have a couple of people on the show and let's hash this out a little bit, because what I said on the show is an accurate statement. But I'm going to read parts of this question because it's a really good question from a listener. He says, Ron was talking about cash flow really only sustains the business. The value of wealth is generated in other returns. And I'd always assumed that the way to retire with real estate was by obtaining multiple properties and then being able to use the cash flow to cover living expenses. Is this a feasible plan? And the answer to that, in short, is yes. But we're going to talk through it. So, Brendan, one of the things that we do internally, we've talked about on the show a ton of times, but we do wealth plans with people, right? So, specifically to this question, how does the wealth plan help a person understand how this works between cash flow and building wealth with the other returns?
Yeah, so a lot of different investors we end up talking to are at different places in their life with the amount of income they need, when they're going to need it. Could be dependent on how close they are to retirement and what that kind of financial picture looks like. So that's why the wealth plan is so important, so that we can really tailor it to the individual. But one thing that's pretty true to everybody we meet is very few people have enough liquid funds just sitting there in their account where they could go buy enough real estate to be financially free tomorrow. And that's where the wealth plan comes into play, is based on the funds and the assets you have available. Where can we start with real estate today to build up and accumulate a portfolio that will eventually support those cash flow or those passive income needs? So it's kind of a combination. It's painting that picture of retiring off of a certain amount of consistent income, but also how do we bridge the gap from where you're at today to actually having that portfolio?
Yeah. And I think, if you sit down with a financial advisor, which we're not, by the way, when you sit down with a financial advisor, they look at, your age, they look at the income that you have, and they're trying to determine a plan that'll get that income to you whenever it is that you want to retire. I think the difference here is that we're trying to say, look, you can probably accelerate this pretty dramatically because of the gains that you can get from real estate, because there's 4 returns. And the fact that cash flow is not the greatest return of the 4 returns doesn't negate its value, and it doesn't make it so that eventually you can't live off of it. What we're trying to accomplish is having one property populate into 2 into 4 into 8, and so on, and then being able to augment that with adding other properties from your cash, right? So We have this. If you think about like a pedigree chart, like a family tree, it starts with two people, right? Grandma and grandpa are up there, and grandma and grandpa have three kids. Three kids get married. Those three kids have three kids, and this tree just keeps growing and growing and growing. Well, the cool thing with investment real estate is that you can just keep adding grandma and grandpas. You can just keep adding to the top of that tree. Every single year, you can add more and more and more, and it doesn't stop the reproducing of more and more and more assets. So your cash flow continues to build, but it continues to build because of the growth that's happening inside of each one of those tiny little businesses called a house or a duplex or a fourplex or whatever they are. That's the thing I think people forget. And we were talking about another example about just living earlier. How people don't treat don't see their investments as they see their life. Explain that to everybody. I'm not explaining it very well, Brendan.
Yeah. I noticed that. I mean, and you've mentioned it on the show before. People kind of hold real estate in this different realm when they're looking at and they're underwriting deals and what they want to get into, versus other investment vehicles. Just basically expectations that they wouldn't have for any other investment. And we kind of do that when we compare it to our own life, right? We have this cash flow number we're building up to. And if we get in the wrong mindset, and we're really just focusing early on in our investment careers on this specific cash flow number we need per unit or per our kind of small portfolio that's building up to something greater, we're essentially telling ourselves, hey, we're living paycheck to paycheck on these investment properties. If something happens, my income is shot for the month. And that kind of mindset can hold us back from investing and actually growing up to that sizable portfolio or kind of like family line of properties that builds up and provides consistent, substantial cash flow. It's just like if you have a 6-figure job and you get hit with your car breaks down, you have to pay a pretty expensive bill. It doesn't negate the fact that you made 6 figures that year. You certainly made less that month as far as what's going in your pocket, but you had reserves, you had income the rest of the year that still supports, and that's where the cash flow sustains the business. Doesn't negate the fact that all of those things that are happening in the background are going to build up and allow you to purchase more units that do the same and act to protect each other.
Yeah. So, I mean, cash flow in that same scenario, it's cash flow can build wealth by purchasing assets that continue to grow. The reason that the cash flow is so important, ultimately, when you build up enough, you have enough cash flow to retire, to your point. But in the meantime, we have the really, really cool thing about and the difference between like a dividend producing stock or an annuity is that those produce a thing, cash flow. That's it. From an annuity, that's all you're going to get. Well, you get an annuity payment with real estate, but you also get incredible growth. And that growth is what produces more cash flow and more opportunity for growth. So, for instance, you have a $100,000 house, it's cash flowing $2,500 a year. I mean, it's not that great. You put $20,000 down and you're cash flowing a little over, what is that? A little over 10% annual return on your cash flow, which actually was really good. If you could find a $100,000 house anymore these days, but you've got this cash flow that's coming in, but you've got a house out there that's worth $100,000 that is potentially going up between 3 and 5% a year. And it's leveraged, right? You only put 20% down. So this bucket is growing faster than the cash flow bucket. And my point in the show the other day is that once this reaches a certain level, you can trade that in for two houses that do the exact same thing. Now, instead of $200, you have $400 a month. More importantly, you have two $100,000 houses or $200,000 that is now going up at 3 to 5% a year. And that's you also have somebody paying down your principal. You also have tax benefits and all of this stuff. It's all going on at the same time. It's pretty hard for cash flow to compete with the three other ones that are going on inside of there as far as the percentage of the return. However, what's going on over there with those three returns should be creating another asset. That's the point, right? So how does this work over time, Brendan, when someone is out and they buy a house or two or three, which is not even close to enough to fund a person's life? How does this plan work over time? I mean, what are you showing people that shows them that that this actually is a feasible plan, that ultimately this works?
Yeah. So one of the cool things you can do initially when you're looking at, like, let's say your first property, you're looking at kind of the holistic returns of it. So your cash flow, of course, is what everybody looks at first, but then principal reduction, depending on what type of loan you've got on the property, appreciation, which, as you said, most of our investors, especially in that accumulation phase, are leveraging. So if the property is appreciating by 3%, you put 20% down, you're actually off a 3% appreciation rate, which is very conservative in a lot of the markets that we do business in. That's a 15% return on your money annually. So dwarfs the cash flow or that dividend just in that. But when you're looking at your first property, most of our investors have consistent income, right? They're kind of professionals, business owners. They have consistent income. Their needs are met right now. They don't need the $250 cash flow to bridge the gap for their bills for the month. So they can take that and put it right back into a savings or reserve account for that property. And when it builds up, like in your $100,000 property scenario, just in cash flow alone, you can buy another property in 8 years off of that cash flow. Now you have two properties. Now you've just doubled the speed of that money to where your cash flow alone, while you're not living on it, can purchase another asset without even dipping into the appreciation gains, the equity that you have in the property. So that allows you to really aggressively start building your portfolio from a couple different avenues. There's cumulative cash flow, reinvesting every time that account builds up enough to where you can purchase a property and still have enough reserves for your current portfolio. You have your own savings that just funds you're putting towards investment out of your normal income, buying property when you can and when it makes sense. And then you have your equity. So you have three different ways you can build your portfolio. And when you compound each of those investment strategies, it almost looks unbelievable when you see a 5-10 year plan laid out. So it's really cool to dive into the numbers like that.
Yeah, I mean, your money goes from doubling. I think you said every 8 years you could buy another property. It gets cut in half just from the appreciation, because if you're getting 15% on your money, just over 4 years is, when you add that in with the principal reduction that's getting paid off, that equity spread means that your equity doubles every 4 years roughly. And so every single 4 years you can double your cash flow, and then you can double your ability to gain again. So now you're getting that 15 to 18% of appreciation money on two separate assets. And this is the most magical piece of this, you only out of your pocket paid for one of those. It's really important that this sinks in. So you bought a house that house bought another one. You didn't, it did. Right. And so if you bought another one at the same time, it would be 2 houses turning into 4 houses. And this thing can grow so exponentially in a short amount of time relative to the rest of the market or the rest of the other investments in the investment world. That, like Brendan said, it's almost not believable until you've experienced it. And we talked to Shane, I don't know, a few weeks ago, and you heard his experience of being a client first and then understanding, oh my gosh, this actually works. Like the math actually works. So much so that he came over here and started working here and then has still continued to really accelerate his portfolio. And most of that portfolio acceleration is coming from his current portfolio, producing more and more and more and more properties. It's a rather remarkable thing. And I don't think that in any other investment that I can think of, this happens. So the answer to your question is yes. Not only is this feasible, but it is. And let's talk about some like exit strategies, right? There's a couple of ways you can continue to do this. So we just talked about the growth strategy. Let's kind of talk about the horrible way that financial planners describe your retirement years, which is end of life planning. It just sounds horrible, but that's what they call it. That should be like beginning of new life, or like rebirth planning or something, but they call it end of life planning. Let's talk about that, because now you've got this pool of assets out there that are doing some cash flow, but there's a lot of equity in there. Now you have so many options and choices. I mean, Brendan, what are some of the things that we teach that people can do? Now I've built up this pool of assets. I actually do have some pretty decent cash flow. What do I do now?
Yeah. I mean, there's so many options as far as once you get to that point, you've built up a portfolio. And by that point, a significant amount of equity. So one of the cool things you can do, and it's a pretty simple math equation, is with that kind of say 10, 15 year target, whatever you've been building up to, if you just take your equity position and take that kind of snapshot, even if you're not there yet, and you're just looking to that point in time, you can take your equity and basically divide it by your cost of repositioning. So your 25% down payment, your 6% fees to a broker to sell it for you, call it 2.5% in closing cost. So it costs you about 33.5% of your money to reposition a portfolio. So if you just divide your equity position at any point in your plan that you've mapped out by 33.5%, it creates a snapshot of how large of a portfolio could you build just by repositioning your equity at that point. So that kind of furthers with the accumulation a little bit, but can do some really cool stuff. Another thing you can do is take that same equity and look at condensing your portfolio into a smaller number of properties, but maybe a different asset class, or some larger multifamily properties, just to condense the amount of units, amount of single buildings you have under management that you're dealing with. And you could also consolidate debt with that amount of equity. You could pay off more properties in cash if you wanted to diversify a bit, reduce the amount you're leveraged, increase your cash flow, your actual dollars a month cash flow, because you're at the stage where you're starting to live off that income. You have so much flexibility. It's really cool to see.
Yeah. So depending on your risk tolerance at that stage of life, at this rebirth stage of life, if you could take, let's work a couple of numbers, and I want to try to keep them really simple because we don't have charts and graphs, and I want you guys to be able to follow. So you have a portfolio with a a net worth, net valuation of $1 million. Okay. With the math that Brendan just said, you should be able to buy, you could sell that property, all of those properties, you could 1031 exchange those into other properties, and you should be able to buy about $3 million worth of properties. Okay. Now, your cash flow should have increased. I don't have the numbers in front of me, and I'm not that quick with math, so I can't determine what that would be. But you've tripled your portfolio size. All things being equal, you should have doubled or tripled your cash flow as well, right? You just bought a bunch more properties, so you've taken $1 million, turned it into $3 million. Now you have $3 million that's doing the exact same thing that your portfolio has been doing all those years. In the second scenario that Brendan was talking about, some people, they don't want debt anymore in their rebirth years. They want to simplify everything. Well, you could sell the same amount of properties and go buy $1 million worth of properties for cash, and your cash flow is going to go up because you don't have any debt on the properties anymore. You just get the full net operating income of those properties to you. So if you have $1 million and you can find a property with a cap rate of 10%, then you're going to get $100,000 in perpetuity forever, while you have $1 million out there that is still increasing in value. And the cool thing is you get to choose, okay, well, I can do this super conservative way over here, and I've still got assets that are increasing in value. They're just not leveraged. Or I can do this leverage thing that I've been doing for a long, long time. I can keep doing it, and I can leverage $3 million worth of properties and do the exact same thing that I was doing before. Or you can do some combination of both. You can pay off some of them, keep a nest egg over that's super conservative and safe, and then you can leverage and like Brendan said, there's so many different ways that you can do this. The reason that you have so many opportunities and options is because now you have enough asset base to actually be able to do that. And that was my point from the podcast before, is that most of that is driven by equity pay down, appreciation, not cash flow. Doesn't mean cash flow is not important. Doesn't mean that we're not driving to have assets that pay for us for the rest of our lives, and then we can gift them to our children so that they get them for their lives. And we could complicate this by a stepped up basis and everything else with your kids, so they don't have to pay the taxes on all of your gains. All of that stuff is all true. None of that happens if you take out the appreciation and equity pay down piece. It stifles the growth. And then, Brendan, to kind of like put a finer point on this, not only did I talk to Shane, but I also talked to Chris Miles recently. And he was talking about the Dave Ramsey plan, right? Where you just start paying cash from the beginning. Well, the only problem with that plan is that you can't grow. It takes so long to grow. What you were saying with the cash flow, it takes a little over 8 years to be able to buy another property with cash flow, which is what you would have to do. And that timeline doesn't speed up if you pay cash for the house. It slows down.
Yep.
That's the beauty of leveraged real estate. Any final words, Brendan?
No, I think we about covered it. It just illustrates how much flexibility you have. But all it takes is really starting, finding a property you can start with and afford today. Will set you down. And set you down the right path.
Yeah, I love it. And so hopefully that answers your question. And by the way, I love the fact that we got another question. I love it when we're answering questions on the show because it makes it more personal for you as you listen. So if you're sitting there and going, "Oh, I actually have a question about this or something else that happened on the podcast," email it in. info@rpcinvest.com. info@rpcinvest.com. Again, Brendan, thank you for coming in and sharing your knowledge with everybody listening. And until next time, get out there and make something happen.
This has been the Get Real Podcast. To subscribe and for more information, including a list of all episodes, go to getrealestatesuccess.com.